Did you know that only 7% of adults in the UK currently own a stocks and shares ISA? And of that 7%, which is just 2.9 million people of a possible 42 million, only 12% have a portfolio of £100,000 or more. Now, I'm not saying this to show off in any way, but I've managed to build a £130,000 investment portfolio in just 7 years, and I'm absolutely no different to anyone watching this video right now. In fact, just 8.5 years ago, I was actually £24,000 in debt. So technically, that's 154,000 swing in net worth if you added that debt on. But people think investing is only for the wealthy, or they worry it's too complicated or risky. Others feel like they need to time the market or wait for the perfect moment to get started. In truth, investing doesn't actually need to be that complicated. Yes, there are certainly complicated strategies out there that require you sitting down and monitoring your investments weekly, daily, or even hourly, but there are also very simple ones that you can set up, automate, and check in a few times a year if you really wanted to. So today, I'm going to show you exactly how I built a £130,000 investment portfolio, and the best part, you can do it too, whether you're just starting out or looking to grow your existing investments. There's a strategy that I use that's an absolute game changer. If you're new here, then my name is Sammy. I recently won Money Content Creator of the Year at the British Banking Awards, and I am on a mission to help Britain get financially fit. If you could do me a favor, as we're now actively looking to grow this channel, and hit subscribe, as I'll be dropping a banger video every few days. Now, first things first, I just want to dispel some myths about investing that hold most people back. And the first is risk. Now, yes, investing comes with some risk. There's no denying that, but risk is amplified when you think short term and by what you invest in. Now, what do I mean by short term? Well, if you're looking to make money from investing today or next month or next year, then you're playing a riskier game, in my opinion, and it requires some serious knowledge and some guts to actually do that. The reason being, the stock market is very unpredictable in the short term and influenced by a range of varying factors such as the news, elections, economic growth, and also just how people are feeling generally at that moment of time. But when you scan out and you look long term, the stock market as a whole has gone one way, and that is up. Now, let's take a look at the Vanguard Total Stock Market Index, also known as the VTI. This, for me, is the best indicator of how the stock market is actually doing as a whole, as this index, which is essentially a list of 7,177 companies from all over the world, is basically the world's economy in one simple thumb. This right here is the latest one-year chart. As you can see, it's done pretty well over the past year, but you can see the ups and downs along the way that it's experiencing, and it's by no means a straight line. In fact, it's dropped a number of times by 5% or more, and that is totally normal. But if you decided to invest the day before it dropped by 5%, you would be pretty worried. I totally get that. But when I scan out and hit maximum here, you can see a very different picture. You can see there's a few big dips, including most recently with 2022 after inflation hit and a big surge in stock prices after COVID in 2020, which you can also see there. And then in 2008 as well, with the financial crisis, which caused a dip and a period of stagnation as well. But look at the trajectory since 2001. If I ran my mouse across this graph here, you can quite literally see it's up and to the right over the long term. So when I invest, I don't worry about tomorrow, next month, or even this year. I think in decades, and just by doing that, I can massively lower my risk. In fact, if you invested this exact index for 15 years or more, you have a 1.6% chance of losing money. But if you invest for 20 years or more, that number is 0.1%. Now, I'm taking those chances every single day of the week. Now, historically, this fund has provided 10.52% on average, an annual average return rate over the past 20 years. And if you take any 10-year period since its inception, then it's over 9.5%. That's a lot more than the 2% our banks have been paying us for saving our money until recently. Of course, yes, it has been higher because of higher interest rates, but when you factor in inflation, it becomes even more important to think about investing so your money is actually growing in value and not going backwards or stagnating, which it will most of the time if it's sitting in a savings account. I'm not saying don't save. It's important to have an emergency fund readily available in a savings account, but once you have that sorted, in my opinion, I think about growing my pot, and that can only be done through investing in some capacity. Second myth I want to dispel before we jump into my strategy is I don't have enough to invest. Now, that used to be true for a lot of people, as investing used to be quite expensive to do. fees were high and you used to have to buy full shares of companies or funds. But when fractional shares were introduced and mobile technology, and with it investing apps became a real thing, this changed the game for everyday people just like you and me. So much so that you can now open an account with some providers. I've left my favorite ones below. You can do that with £1 in some cases and buy stocks and funds with that pound. Some investing platforms have slightly higher limits, but the one I use is £10, which isn't a huge amount in the grand scheme of things, which means you do have enough money to invest if you've got rid of your debt and have an emergency fund, I might add. For me, that is the first step you should take before investing, but I have a link to a video at the end which can help you with the steps of building wealth, so stick around for that coming up soon. The last myth is, I don't know enough about investing, so I don't do it. Now, this one I get because you want to know what you should be doing, and I think you should know what you'd be doing before you do anything, pretty much. But what I will tell you is that you can learn pretty much all you need to know from a handful of videos on my channel or others like it, or from a good book in literally a couple of hours. There's a big difference between trading for short-term gains and investing for the long term. And there's a big difference between investing in individual stocks to investing in funds, for example. For me, the latter of those two, you can learn everything you need to get started in just a couple of hours, as I was mentioning before. And if you want, and I might add only if you want, because you don't need to, I'll explain this more in a minute, do you actually need to learn more about even individual stock picking? You don't even have to know that to be an investor. Okay, so how have I done it in just 7 years? Let's actually dive into my strategy. Well, first off, my contributions will differ from yours, and that is totally fine. It might be the same, but it's likely to be different. It's not a game of me versus you here. I'm currently investing £750 to £1,000 a month because my income allows me to do that. I was also receiving bonuses between £3,000 and £5,000 every quarter back when I was working in marketing and sales, and I invested large portions of that too. But I didn't start there. In fact, I started with £200 a month and have worked up to that amount over the years, and I think anyone who starts should actually do that as well. Start small, get the hang of it and create a habit, and then you can up it later on if you want to. What you need to do is work out how much you can actually contribute each month. This should be money you're willing to put towards investing for at least 10 years or more, in my opinion. If that's £10 or £1,000 a month, the actual amount will only affect how much you can realistically grow. That amount is personal to you based on your income, your family situation, your family size, your outgoings, and lots of other things here too. It's not, as Sammy said, I need to invest £700. Personal finance is personal. But yes, the more you can contribute, the faster you can potentially grow your wealth. I won't sugarcoat it because that is just a fact. So work out what you can afford, and then you want to basically open an investing account. Now, I like stocks and shares ISAs because I can contribute £20,000 per tax year, and any gains, interest or dividends that I receive are completely tax-free. So I could actually withdraw that entire 130 grand today and not pay a penny on tax in it, which is pretty cool and unique to the UK where these accounts exist. Now, I've left a link to my 2 favorite ISAs below in the description. So let's dive into where I actually invest. So a big portion of my money sits in index funds. Now, index funds are simply lists of companies from a particular region, country, or in some cases the entire world, like we saw with the VTI or the Vanguard Total Stock Market earlier in this video. Now, I put between 70 and 80% of my money into these each month, and I own 2 major ones. The VTI, as we mentioned before, and the S&P 500, which is the 500 largest companies in the USA. The reason why I like these is essentially I'm investing into human progress, or the world's economy. A great book on this is How to Own the World by Andrew Craig, which summarizes this brilliantly for me. If humans continue to progress and innovate, then the companies they do this with will help me and you, if you invest into them, grow your wealth. Now, I also own a UK-based trust called Temple Bar Investment Trust, which holds a range of UK-based companies in energy, retail and finance and media as well, but this is slightly smaller, holding to the larger of the 2 index funds. So with my index funds and my trust, I'm spreading my investment across hundreds, or in the case of the VTI, thousands of companies from all over the world. With index funds, I don't worry about picking the right stock because these funds essentially mirror the market. When the market goes up over the long term, my portfolio grows with it. Now, the beauty of index funds is that they're also passive. I don't need to check the stock market every day or worry about what's happening with individual companies. Instead, I set up automatic contributions every month and the funds do the rest. That means I can focus on other areas of my life without stressing about my investments all the time. But I can hear you going, what about the other 20 to 30% 80% as you've only invested 70 to 80% of your money so far? Well, this is called the 80-20 strategy. So let's dive into the remaining 20% of my portfolio, which I allocate towards individual stocks and even a small portion into cryptocurrency as well. This is what's known as the 80-20 strategy. So 80% of my money is in low risk, broad market index funds and that trust, and the 20% goes into higher risk investments like individual stocks or alternative assets like crypto, for example. I don't suggest this approach to everyone, especially if you're just starting out, but if you feel comfortable and have done your research, this can be a potentially way to boost your returns over the long term. Now, I just want to make it clear here that you could just pick index funds and go about your merry day. This next part is for those who are interested in picking individual companies or higher risk investments to essentially try and grow your returns more. You could do very well, as you've seen from the average returns from the indexes that I've mentioned before, but I love business and I love using my competitive edge here within my 20%. So here's how I handle this part, this 20% of my portfolio. When it comes to individual stocks, I focus on quality companies with strong track record, strong financials, and a competitive edge in their industry. I'm talking about businesses that are likely to be around and growing for the next 10, 20, or 30 years. Think about companies like Apple or Microsoft or Amazon, those big names that have shown resilience in innovation over the time, basically. Now, I don't actually own individual holdings with Apple, Microsoft, or Amazon because I own a significant amount of these within my index funds. What I'm looking for is the next big Apple or Microsoft, and these companies are a lot smaller but have the potential to massively disrupt their industries. But remember, when you invest into individual stocks, you are taking on more risk than you would with an index fund. Now, I see funds like boxes of celebrations and individual stocks like chocolate bars. Funds have lots of chocolates in, and one bar is one bar or one company. If that one bar does badly within a fund, it's often balanced out. But if it's all that you own, then you're exposing yourself to a much higher risk. If you own one company, it's higher risk. So that's why I limit this to 20% of my portfolio. I'm not trying to gamble or day trade. I am looking for long-term value. Now let's talk about the cryptocurrency aspect. I do have a small allocation in it. I know it's controversial and volatile for some people, but I see it as a potential growth opportunity as long as you treat it with caution. So personally, I've allocated only 5% of my total portfolio to two of the biggest in Bitcoin and Ethereum. This is definitely more a speculative part of my portfolio, and I'm fully aware that I could lose my money here. Now, if you're thinking of dipping your toes into crypto, make sure you're only investing money that you can afford to lose. For me, it's a calculated risk and it's a very small portion of my overall investments. Now, one more thing I want to mention is about rebalancing. Every year or so, I like to rebalance my portfolio to make sure it aligns with my goals. If one area, like an individual stock, starts to take up too much of my portfolio due to some strong gains, then I might sell some shares and move that money back into my index fund to maintain that 80-20 balance. This keeps my risk level in check and ensures my portfolio stays diversified as I want it. Now, the most important piece of this is to stay consistent. Investing isn't about timing the market, it's about time in the market. I've been investing regularly every month for 7 years, regardless of what the market was doing. Whether it was up or down, I stuck to my plan and I trusted the process. And that's what's allowed me to build a £130,000 portfolio here. So some months and even some years, like in 2022, it might feel like you're not seeing progress and potentially it could even go backwards. But trust me, over time, that consistency will help pay off. The magic of compounding works best when you give it the time to grow. Now, I am living proof of that. The video I mentioned before earlier, which I think is actually a perfect one to continue from this if you're starting out, is grow your wealth to 100K step by step, and that's coming up on screen now. Or if you're debt free and perhaps want to learn more about investing in particular things, then my index funds for beginners video is a good one too, and that's coming up there. Both of these are on your screen now, and I'll see you over there, and peace out guys, it's been a pleasure.